On September 17, 2019, something broke in the financial system. The overnight repo rate, the interest rate banks charge each other for overnight loans, spiked from 2% to 10% in a matter of hours. This wasn't supposed to happen. The repo market is the plumbing of the financial system. Banks lend each other cash overnight, every night, to balance their books. It's boring, mechanical, invisible. A spike from 2% to 10% meant banks were refusing to lend to each other. They were hoarding cash. Something had spooked them. The Federal Reserve intervened immediately. They injected $75 billion in emergency liquidity. The next day, another $75 billion. By the end of the week, $400 billion. Nobody reported it. There were no headlines, no press conferences. The Fed quietly pumped hundreds of billions into the banking system to prevent a collapse. And nobody asked the obvious question: why did banks suddenly need $400 billion in emergency cash? The answer reveals the fragility underneath the entire financial system. Because banks don't have cash. Not really. Your deposits exist as numbers on a screen backed by a fraction of actual dollars. When everyone needs cash at once, most of it doesn't exist. September 2019 was a warning. The system almost seized. The Fed printed $400 billion to prevent it. Then came March 2020. COVID panic. Markets crashed. The Fed injected $4 trillion. Then came March 2023. Silicon Valley Bank collapsed in 48 hours. Depositors withdrew $42 billion in a single day. The cash wasn't there. The FDIC seized the bank. Each crisis gets larger. Each intervention gets bigger. Each recovery leaves the system more fragile. And the next one is coming. Because the underlying mechanism hasn't changed. There still isn't enough cash. There are still $18 trillion in deposits backed by $3 trillion in reserves. There are still $2 quadrillion in derivative claims on dollars that don't exist. The 2026 liquidity crisis won't be like 2008. It will be faster, larger, and the Fed may not be able to stop it. Let me show you how liquidity crises work, why they're inevitable in our current system, and what happens when the cash actually runs out. Mechanism 1. Fractional reserve. Why your money doesn't exist when you deposit $10,000 in a bank. You assume the bank has $10,000 sitting in a vault somewhere. They don't. Under fractional reserve banking, banks are only required to keep a fraction of deposits as reserves. The rest they lend out. You deposit $10,000. The bank keeps $1,000 in reserve. They lend $9,000 to someone buying a car. That person pays the car dealer. The dealer deposits $9,000 in their bank. That bank keeps $900 and lends $8,100, and so on. Your original $10,000 deposit has created $90,000 in total deposits across the banking system. But the actual cash? Still $10,000. This is called the money multiplier. It's how banks create money from nothing. And it works perfectly as long as everyone doesn't want their cash at the same time. But here's the terrifying part. In 2020, the Federal Reserve reduced reserve requirements to 0. Banks don't have to keep any reserves, 0%. This means banks can lend out 100% of deposits. Your $10,000 can become $100,000 or $500,000 in loans. The multiplication is unlimited. And the actual cash backing all these deposits? A tiny fraction. Currently, there are $18 trillion in U.S. bank deposits. The Federal Reserve has created about $8 trillion in base money. But most of that is held as bank reserves at the Fed, not as physical cash. Physical currency in circulation? $2.3 trillion. So there's $18 trillion in deposits and $2.3 trillion in physical cash. If just 13% of depositors wanted physical cash, there wouldn't be enough dollars in existence. And it's worse than that, because those $18 trillion in deposits are just the beginning. Money market funds hold $6 trillion. Treasury bills held by the public, $8 trillion. Corporate bonds, $10 trillion. All of these are considered cash equivalents. People assume they can convert them to cash instantly, but they can't, not all at once, because the cash doesn't exist. This is the fundamental fragility of the financial system. Everything is a claim on cash, but there's far more claims than cash. When confidence holds, it works. Everyone believes they can get cash when needed, so nobody rushes to get it. When confidence breaks, everyone rushes for cash simultaneously, and they discover most of it was never there. Crisis 1. 1929, How Liquidity Collapse Created the Great Depression. The stock market crash of October 1929 wasn't supposed to cause a depression. Stock crashes had happened before. The economy usually recovered within a year. But 1929 was different, because the crash triggered a liquidity crisis that destroyed the banking system. Here's what happened. In the 1920s, banks had lent heavily to stock speculators. Margin loans let investors buy stocks with 10% down. Banks provided the other 90%. When stocks crashed, speculators couldn't repay their margin loans. Banks took losses. Depositors heard about the losses and got nervous. In December 1930, the Bank of the United States failed. Despite its name, it was a private bank in New York. 400,000 depositors lost their savings. Panic spread. Depositors at other banks started withdrawing cash. They lined up outside banks demanding their money. But the money wasn't there. Banks had lent it out. They couldn't give every depositor their cash simultaneously. Banks tried to raise cash by selling assets. But everyone was selling. Nobody was buying. Asset prices collapsed. Banks that were solvent on Monday were insolvent by Friday because their assets had lost 40% of value. Between 1930 and 1933, 9,000 banks failed. One-third of all American banks, $7 billion in deposits, vanished. That's $140 billion in today's money. The money didn't disappear because of bad investments. It disappeared because of a liquidity crisis. Everyone wanted cash at the same time. The cash didn't exist. Banks collapsed trying to find it. And here's the mechanism that turned a stock crash into the Great Depression. When banks collapsed, the money supply collapsed. Remember fractional reserve banking. Deposits are money. When banks fail, deposits vanish. When deposits vanish, the money supply shrinks. The U.S. money supply shrank by 33% between 1929 and 1933. One-third of all money in the economy simply disappeared. Businesses couldn't get loans. Consumers couldn't spend. Prices collapsed. Unemployment hit 25%. The Great Depression wasn't caused by the stock crash. It was caused by the liquidity crisis that followed. The banking system ran out of cash and imploded, and it happened in 90 days. From the October 1929 crash to the first wave of bank failures in December 1930, just 14 months. From the Bank of the United States failure to complete banking system collapse, 27 months. Liquidity crises move fast, and once they start, they're almost impossible to stop. Crisis 2, 2008, 72 hours from total collapse. By 2008, the financial system had evolved far beyond 1929. Banks were larger, regulations were stronger. The Federal Reserve had tools to prevent liquidity crises. None of it mattered. On September 15, 2008, Lehman Brothers filed for bankruptcy. The fourth largest investment bank in America, with $639 billion in assets, collapsed overnight. But Lehman's failure wasn't the crisis. It was the trigger. The real crisis was in the overnight lending market. Banks lend each other money every night to balance their books. It's called the repo market. Boring, mechanical, essential. After Lehman failed, the banks stopped lending to each other. Nobody knew which bank might be next. Nobody wanted to lend money overnight and discover their counterparty was bankrupt by morning. The repo market froze. Banks couldn't borrow overnight cash. Without overnight cash, they couldn't meet obligations. Without meeting obligations, they'd be declared insolvent. Here's what almost happened. On September 18, 2008, 3 days after Lehman, money market funds started breaking. The Reserve Primary Fund, a $62 billion money market fund, had held Lehman commercial paper. When Lehman defaulted, the fund's value dropped below $1 per share. It broke the buck. Money market funds are supposed to be as safe as cash. Millions of Americans and businesses kept operating cash in money market funds. If they could lose money, nobody was safe. Investors started redeeming money market funds. $300 billion in redemptions in a single week. The funds had to sell assets to meet redemptions. Asset prices collapsed further. Treasury Secretary Hank Paulson later revealed what almost happened that week. In a meeting with congressional leaders, he said the financial system was hours from complete collapse. If they hadn't guaranteed money market funds and injected liquidity, every major bank in America would have failed within days, not weeks, days. The Federal Reserve injected $1.2 trillion in emergency lending. The Treasury guaranteed all money market funds. Congress passed a $700 billion bailout. It barely worked. The system survived. But only because the government pledged unlimited resources to prevent collapse. And here's what's terrifying. The system is more fragile now than in 2008. Banks are larger. Derivatives exposure is greater. The Fed's balance sheet is already bloated from previous bailouts. Interest rates are higher, which means asset prices are lower, which means collateral is worth less. The next liquidity crisis will be faster and larger than 2008. And the Fed may not have enough ammunition to stop it. Crisis 3, 2019 and 2023, the warning shots. Most people don't know the financial system almost broke in September 2019, 6 months before COVID. On September 17, 2019, the overnight repo rate spiked from 2% to 10%. Banks were suddenly desperate for overnight cash and willing to pay any price. Why? The official explanations were corporate tax payments and Treasury auction settlements creating temporary cash shortages. But $75 billion in emergency Fed injections don't happen because of temporary problems. The Fed injected $400 billion over 2 weeks. That's crisis intervention. The real problem was structural. Banks didn't have enough reserves. Years of quantitative tightening had drained liquidity from the system. And when a small cash demand spike hit, there wasn't enough cushion. The Fed's response was revealing. They started not QE, purchasing $60 billion Treasury bills per month to inject permanent liquidity. They pretended it wasn't quantitative easing. But it was. September 2019 showed that the system was already fragile before COVID, already dependent on Fed intervention, already running on fumes. Then came March 2020. COVID panic triggered the fastest market crash in history. The S&P 500 dropped 34% in 23 trading days. Treasury bonds, supposedly the safest asset, became impossible to sell. The Treasury market froze. When the Treasury market freezes, everything freezes. Treasuries are collateral for the entire financial system. If you can't sell treasuries, you can't raise cash. If you can't raise cash, you're insolvent. The Fed intervened with $4 trillion unlimited QE, corporate bond purchases, municipal bond purchases, international swap lines. They bought everything to provide liquidity. It worked. The system survived. But only because the Fed expanded its balance sheet by $4 trillion in months. Then came March 2023. Silicon Valley Bank collapsed in 48 hours. Depositors withdrew $42 billion in a single day. The largest bank run in American history, measured by speed. SVB had $200 billion in assets. They held long-term Treasury bonds. When interest rates rose, those bonds lost value. SVB was technically insolvent, but nobody noticed until depositors panicked. The run started on Thursday morning. By Friday afternoon, the FDIC had seized the bank, 48 hours from healthy bank to government seizure. And here's what made 2023 different. Social media accelerated the bank run. Depositors organized on Twitter. Group chats spread the word. The run happened in hours, not days. Signature Bank failed days later. First Republic failed weeks later. $500 billion in bank assets collapsed in a month. The Fed created an emergency lending facility called BTFP, Bank Term Funding Program. They offered to lend banks cash against their underwater bonds at face value. Another bailout disguised as a facility. 3 liquidity crises in 4 years. September 2019, March 2020, March 2023. Each one required emergency intervention. Each one was larger than the last. The pattern is clear. The system is deteriorating. Each crisis requires bigger bailouts. Each recovery leaves less cushion. The next one is coming. Why 2026? The convergence. Several structural factors are converging to create the conditions for a major liquidity crisis by 2026. Factor 1. Debt maturity. While $9 trillion in corporate debt matures between 2025 to 2027, this debt was issued at 2 to 3% interest rates. It must be refinanced at 5 to 7% rates. Companies will need to roll over this debt. That requires cash. Banks will need to lend. That requires liquidity. If the system is stressed when this maturity wall hits, companies can't refinance. They default. Default spread. Liquidity evaporates. Factor 2. Commercial real estate collapse. $1.5 trillion in commercial real estate loans mature by 2026. Office buildings are worth 30–50% less than when the loans were made. Remote work has permanently reduced demand. Banks holding these loans face massive losses, regional banks especially. The same regional banks that almost collapsed in 2023. When banks take losses, they hoard cash. When they hoard cash, lending freezes. When lending freezes, the economy seizes. Factor 3. Treasury market dysfunction. The U.S. government issues $2 trillion in new debt per year. Someone has to buy it. Traditionally, that's been foreign governments, pension funds, and banks. But foreign governments are reducing treasury holdings. China has sold $500 billion in treasuries since 2018. Japan is selling. Saudi Arabia is selling. Pension funds are selling to meet redemptions. Banks are selling because they lost money on treasuries in 2022-2023. Who buys $2 trillion per year if traditional buyers are selling? The Fed, which means more money printing, which means more inflation, which means higher interest rates, which means more treasury losses. A doom loop. Factor 4. Derivative exposure. Global derivatives outstanding. $2 quadrillion. That's $2,000 trillion for reference. Global GDP is $100 trillion. Derivatives are bets on interest rates, currencies, commodities, stocks. They require collateral. When the value of collateral drops, derivative holders must post more cash. In a crisis, collateral values drop. Everyone needs cash for margin calls. Nobody can get it. The derivative market seizes, counterparties fail, contagion spreads. The 2008 crisis was triggered by $60 trillion in credit default swaps. The current derivative exposure is 30 times larger. Factor 5. Fed limitations. In 2008, the Fed had a $900 billion balance sheet. They expanded to $4.5 trillion. They had room. In 2020, the Fed had a $4 trillion balance sheet. They expanded to $9 trillion, still had room. Today, the Fed has an $8 trillion balance sheet. They've been trying to reduce it. But every crisis forces them to expand again. How large can the Fed's balance sheet get? $15 trillion, $20 trillion? At some point, the cure becomes worse than the disease. Printing unlimited money destroys the currency. The Fed may face a choice in 2026. Let the system collapse, or print so much money that the dollar collapses. Neither option ends well. What happens when cash disappears? When the liquidity crisis hits, here's the sequence. Day 1 to 3. Market freeze, stock markets halt trading. Circuit breakers trigger when prices fall too fast. But the halts don't restore confidence. They increase panic. Bond markets freeze. Nobody will buy. Prices are unavailable because there are no bids. The repo market seizes. Banks stop lending to each other. Overnight rates spike to 15%, 20%, whatever it takes to get cash. Day 3 to 7, bank runs. Begin depositors see the market chaos. They start withdrawing cash. Lines form at banks. ATMs run dry. Banks implement withdrawal limits. $500 per day, then $200. Some banks close branches entirely. Wire transfers slow down. Banks delay processing to conserve cash. Your paycheck deposit takes 5 days instead of 1. Day 7 to 14. Payment system. Breakdown businesses can't make payroll. Direct deposits fail. Paper checks bounce because banks won't honor them. Credit card transactions start declining. Merchants can't verify balances. They demand cash. Supply chains seize. Truckers won't deliver without guaranteed payment. Grocery stores empty. Gas stations run dry. Day 14 to 30, emergency measures. The government declares a bank holiday. All banks closed for restructuring. Your deposits are frozen. The Fed prints trillions, but printing money takes time to circulate. The cash shortage persists for weeks. When banks reopen, your account balance is there, but withdrawal limits remain. $300 per week, and prices have doubled. This isn't speculation. It happened in Greece in 2015, bank holiday. ATM limits of $60 per day, capital controls for months. Businesses collapsed because they couldn't pay suppliers. It happened in Cyprus in 2013. Deposits over $100,000 were seized, converted to worthless bank stock. People lost their life savings overnight. It happened in Argentina in 2001. The Corralito froze all bank accounts. People couldn't access their money for a year. The peso was devalued 75%. Liquidity crises are not theoretical. They happen. And when they happen, ordinary people lose access to their own money. The truth they won't tell you. Your money in the bank isn't really there. It's a number on a screen backed by a fraction of actual cash. The financial system functions on confidence. Everyone believes they can get cash when needed, so nobody rushes to get it. The belief sustains the system. But the cash doesn't exist. There's $18 trillion in deposits and $2.3 trillion in physical currency. The math doesn't work if confidence breaks. And confidence is breaking. September 2019, March 2020, March 2023. Each crisis required larger interventions. Each recovery left less cushion. The system is deteriorating. The convergence coming in 2025-2026, corporate debt maturity, commercial real estate collapse, treasury market dysfunction, derivative exposure, Fed limitations, creates the conditions for a liquidity crisis larger than anything we've seen. When it hits, cash will disappear. Not gradually. Overnight. ATMs will empty. Transfers will freeze. Withdrawals will be limited. And by the time you realize what's happening, it will be too late to get your money out. If this changed how you see the banking system, if you finally understand why your deposits aren't really there, and what happens when everyone discovers this at once, then you're starting to see the fragility. Subscribe if you want to understand how to position before the liquidity crisis hits. Because they're not going to announce it in advance. They're going to tell you the system is stable right up until the moment it isn't. And when the cash disappears, most people will be standing in line at an empty ATM wondering what happened. Don't be one of them.